So the fact that Spotify is a massive loser is well known. However, what is less known is how do they manage to continue to run a company for almost 2 decades without making a profit. Now last year I made a video about why Spotify is a giant bubble and why I was shorting the company, and given the recent downfall of the stock, I'm glad to report a healthy profit. However, based on the recent comments, I feel like I haven't fully highlighted how Spotify was getting its cash to finance this giant bubble. So in this video we're going to focus more on the cash flow. Because traditionally, the model of starting a company was you make a loss in your first year, greatly reduce this loss in your second, and you break even or turn a small profit in your third year. However, since the explosion of internet companies, it has sort of become a new normal that big tech doesn't need to be profitable. There's this air of elitism that we don't care about money and we only focus on growth. Well, that's nice and all, but somebody still has to pay for your daily $10 soy latte, your seemingly cheap but actually $4,000 costing bicycle, and your $180,000 a year salary that doesn't even include bonuses and extra benefits, which is not bad for people that claim not to care about profits. So where is all this money coming from if the company has been losing money for the past 16 years? And more importantly, how is this even sustainable, especially given the current developments in the industry? Spotify is under heavy fire for censoring creators on its platform, which the company only seems to be doing because of public pressure, and this external pressure is not going away anytime soon. In addition to this, the streaming market is only getting more and more competitive, which is going to make it even more difficult to raise profits, especially if you are forced to buy creators from other platforms. So to understand how Spotify is financing this 16-year loss, all we have to do is look at the balance sheet, and here we find something interesting. From 2015 all the way up to last year, Spotify increased its cash and cash equivalents from a mere $597 million all the way up to $2.7 billion, all while losing hundreds of millions of dollars a year. In 2017, Spotify even lost $1.2 billion, however their bank accounts are bursting with money and they can still pay all of their employees. Now there are indeed businesses and industries where you can easily make an accounting loss and still keep the money in your bank account. Real estate, for instance, is well known for doing this. However, with Spotify, it's not a clever accounting hack. They are actually spending way more money than they make, and somehow they seem to never run out of it. So how do they do it? Well, this is where the logic of the growth value model comes in, and I use the term logic loosely here, since in the case of Spotify, I do not agree with it at all. However, this is how their own investors and creditors are looking at it, so let's run with it. You see, as long as Spotify is able to increase the number of users and thus strengthen its dominance in the industry, investors assume that the company will somehow find a way to monetize these users on the platform. Basically, do the Facebook thing. This means that as Spotify grows, the stock price grows, and the company uses this stock price to get access to lots and lots of money. In 2016, for instance, Spotify secured a $1 billion loan that was actually arranged by 2 investment companies, TPG and Dragonair, and of course, Goldman Sachs, since when are they ever not involved in a complicated, shady deal? Anyways, this loan was a very special one, since it forced Spotify to hurry up with the IPO, because the longer Spotify took to get the company listed on the stock exchange, the better the terms of the loan would get for the lenders. Now eventually, the lenders turned this debt into shares and then sold these shares to Tencent, a major technology and entertainment company, and this is where the financial magic truly happened. Since somehow TPG and Goldman managed to convert this $1 billion loan into a $10 billion share valuation, which was then sold for about $20 billion to Tencent. Yeah, this kind of financial trickery had even some of the regulators confused, but nothing ever came from it, and the road was clear for the Spotify IPO. However, this does illustrate how lucrative it is for major financial institutions to keep doing business with companies that are losing money but have a share price that keeps increasing. Before we continue, please like and subscribe to help support the channel. TPG, Dragonair, and Goldman did not care at all about Spotify's long-term business potential, their ability to execute on a vision, or the company's profitability. All they care about is the stock price. And this allows Spotify to finance operational activities such as paying the staff, spending on marketing, and basically buying Joe Rogan. So for the past years, this way of operating has worked perfectly well because the company kept growing very fast and was even helped by the global pandemic, which catapulted the stock price. However, as soon as they announced a slower growth than expected, the stock took a nosedive, and this is exactly the problem with the growth value model in the case of Spotify. because Spotify loses over 70% of the money it generates to the record companies since they hold all the rights to the music licenses. And the funny thing is, artists and the record companies aren't even happy about this deal.
My daughter had a 10 million, Sophie Simmons had a 10 million viewed single last year, 2 years ago. 10 million, she made $214. Spotify's taking all the money. The acts are taking a small percentage of 1 penny per download, which is a crime.
There's a reason that Tool waited as long as they did to put this stuff up on streaming services, because they knew they weren't going to be compensated for something that they worked their asses off.
The problem here is that Spotify simply doesn't make enough money from the people that are using the platform, because the more a user uses the platform, the more Spotify has to pay to the artist. However, the user is not paying more based on the usage. Now, Spotify is trying to remedy this fault in their business model with podcasting and other products, since with those products, Spotify either owns the content or only has to pay for it once. However, that's still just a small part of their business, and it's already causing some major problems.
The stock price today pretty much is at the same level as it was when they signed Rogan. Rogan's podcast probably hasn't been worth this headache.
The Joe Rogan problem was just one podcast on the platform, and it caused a worldwide disaster for the company. So when you think about the fact that there are thousands of controversial podcasts on Spotify, it's only a matter of time before one of them blows up and becomes a major problem as well. Now, some of you might say, yeah, but those podcasts aren't signed to Spotify, so there is no direct link with the company. Well, that actually highlights a whole nother problem, because if podcasting is going to save the failing business model, then the question is Spotify going to buy all these other creators to be exclusive? Because otherwise people have dozens of options to listen to the same podcast on other platforms. We saw this buying of creators fully unfold with Mixer when it went to war with Twitch and started buying gaming streamers. However, Mixer collapsed, and the only ones who profited from this war were the streamers themselves. This shows that buying creators is just a futile attempt to prop up your platform, and in the Joe Rogan case, it actually did some serious damage. Not to mention that he already has a new $100 million contract ready and waiting, so as soon as his contract ends, he can just go to another platform, just like we see gaming streamers do all the time. Spotify fails to understand that most podcasts are popular because people speak their minds and are speaking about controversial topics that are usually not allowed on other platforms or simply underserved. This type of content comes with a lot of scrutiny and is going to give you many problems in the coming years.
Talk to us about the options that Daniel Ek and Spotify have in this moment.
He doesn't have a lot of good ones. You know, when you have one of your biggest stars saying some of the horrible things that he said in the past, it puts you in a tricky position.
So when you have to deal with artists and music labels complaining that they're not getting paid enough and therefore decide to leave your platform, plus users complaining about the things being said on your platform and also decide to leave, plus your growth slowing down, plus competition intensifying, it all becomes this perfect storm. So when you have over 150 million users paying you monthly to access your platform, and you are still not able to make significant profits, it proves that your business model is trash and you need some serious innovation. Spotify has had over 16 years to transform their user base into a more sustainable and profitable product, and they have failed at doing so, which begs the question, is Spotify's leadership even capable of doing so, or do they need someone else who can better navigate this digital era? This was How is Spotify Paying Its Bills? Please like and subscribe for more videos.